Every few decades, it happens again. Boom turns to bust. The rich panic, the poor suffer, and governments scramble to stop the bleeding. From tulips to tech stocks, bubbles have formed and popped for over 400 years. But here's the twist. It's not the events that repeat, it's us. Speculators rush in, regulators look away, and the same warning signs get ignored. This is the story of every major financial crash in history. And if you think the worst is behind us, you might want to think again. Tulip Mania, 1637. This crash started with flowers and ended with fortunes wiped out overnight. In 1637, the Dutch Republic was at its peak. Trade routes spanned the globe, wealth poured into the cities, and a rare flower, the tulip, became the hottest status symbol in Europe. As tulips with unique patterns appeared, demand skyrocketed. Wealthy merchants, artisans, and even working-class citizens began speculating on bulbs. Futures contracts allowed people to trade promises for tulips that hadn't even bloomed. In February of that year, one auction failed to attract any buyers. That single moment shattered confidence. Within days, the entire market unraveled. People panicked. The price of bulbs collapsed by 90% in a matter of days. While there wasn't a full-blown banking collapse, thousands were financially ruined. Many had borrowed heavily or sold property just to chase the tulip dream. The government stepped in to try to mediate contracts, but the damage was done. Confidence in the market evaporated, and the Dutch economy slowed. If tulips sound like a strange thing to gamble an economy on, just wait until you hear how Britain put its faith in an imaginary sea. The Great Depression, 1929. This one started with champagne and skyscrapers and ended with bread lines and mass unemployment. By the late 1920s, the United States was on a high. The stock market surged, radios, cars, and home appliances filled every catalog. Easy credit flowed freely, and people from all walks of life began buying stocks, many on margin, using borrowed money. Banks joined the frenzy, investing depositors' funds directly into the market. It felt like endless growth. But beneath the surface, cracks were forming. Agricultural debt was mounting, wages were flat, stock prices became completely unmoored from real company performance. And then came October 24th, 1929. Black Thursday. Panic selling hit Wall Street. 5 days later, the bottom fell out again. Billions of dollars in value were erased. Over the next 3 years, the market would fall nearly 90%. Banks collapsed, businesses folded. 1 in 4 Americans found themselves without work. Families lost homes. Soup kitchens and bread lines became daily reality. Global trade broke down. European economies buckled under pressure. In Germany, desperation helped fuel the rise of dangerous political ideologies. Around the world, governments scrambled to respond, but often made things worse with tariffs and austerity. And while the crash stretched across a decade, the next one, it took just a single day to shake the entire planet. Black Monday, 1987. This crash took only hours, and it rewrote the rules of modern finance. On October 19, 1987, global markets plunged without warning. The Dow Jones fell 22% in a single trading day, the largest percentage drop in U.S. history. There was no war, no housing crisis, no global pandemic, just a wave of panic, amplified by machines. Throughout the 1980s, Wall Street had embraced computerized trading. These early algorithms were designed to sell when prices dipped to minimize losses. But as the market opened that Monday morning, a few big sell orders triggered a chain reaction. The computers kicked in, one after another, accelerating the sell-off. By the end of the day, over $1.7 trillion in global value had evaporated. Stock markets in London, Hong Kong, and Tokyo followed the same pattern. Phones stopped ringing. No one wanted to buy. There was no floor. But unlike previous crashes, this one didn't spiral into a deep recession. The Federal Reserve moved quickly to inject liquidity and calm the panic. Within weeks, markets stabilized. Still, the fear stuck. It was the first real glimpse of how fast technology could turn fear into free fall. And the next crash, it didn't start in Wall Street or London. It began in one nation, jumped borders overnight, and brought half of Asia to its knees. Asian financial crisis, 1997. This one started with a currency falling and ended with entire nations in economic freefall. In the early 1990s, Southeast Asia was a global success story. Thailand, Indonesia, South Korea, and others were dubbed tiger economies for their rapid growth. Money flowed in. Real estate boomed. Currencies were pegged to the US dollar to keep foreign investors confident. But that peg became a trap. Behind the scenes, local banks were drowning in risky loans. Governments had overpromised, and as debt piled up, international confidence began to wobble. Then on July 2nd, 1997, Thailand ran out of reserves and let its currency float. The baht immediately collapsed. Within days, panic spread. Currencies across Asia fell sharply. Investors fled. Stock markets crashed. Entire economies ground to a halt. Indonesia rupiah lost over 80% of its value. Unemployment soared. Riots erupted in the streets. Governments fell. Global lenders like the IMF stepped in with bailouts, but the political and social damage had already been done. The myth of Asia's unstoppable rise was broken. And just a few years later, the world would fall for a new dream. Not real estate, not trade routes, but a digital future built on clicks, code, and pure speculation. The dot-com bubble, 2000. This one wasn't built on gold, oil, or property. It was built on websites with no profits and dreams written in code. By the late 1990s, the internet was the new frontier. Every startup with a .com in its name could raise millions overnight. Investors weren't asking if a business made money, just if it had a catchy domain. Tech IPOs doubled on their first day. Pets.com, eToys, Webvan, these companies were everywhere and Wall Street couldn't fund them fast enough. But under the surface, there were no earnings. No sustainable models. Burn rates were outrageous, and by early 2000, doubt crept in. One weak earnings report became a trigger. The Nasdaq started falling, and didn't stop. Over 2 years, it dropped nearly 80%. Trillions of dollars vanished. Startups shut down. Even tech giants like Amazon lost nearly 90% of their value. Offices emptied, thousands of jobs were lost, Silicon Valley went quiet, and yet some companies survived. Google, Apple, Amazon. The crash didn't kill the internet, it cleared the fog. But the lesson was clear. Hype without substance is a time bomb. Still, nothing prepared the world for what came next. A crash so wide, so deep, it nearly brought the global economy to a halt. The global financial crisis, 2008. This crash was hiding in plain sight, inside mortgages, banks, and glossy suburban homes. In the early 2000s, the American housing market was unstoppable. Banks handed out mortgages to anyone. No income, no assets, no problem. These risky loans, known as subprime mortgages, were bundled into complex financial products and sold globally as safe investments. Ratings agencies gave them top marks. Everyone believed the system was solid. But inside those bundles were time bombs. As homeowners began defaulting, the cracks widened. By 2007, foreclosures surged. And in September 2008, the tipping point arrived. Lehman Brothers, one of the largest investment banks in the world, collapsed. Markets panicked. Credits froze. The Dow plummeted. Banks around the world scrambled for liquidity. In just weeks, over $2 trillion vanished from global markets. Entire industries teetered. Millions lost homes, jobs, and retirement savings. Governments unleashed massive bailouts. Central banks slashed interest rates. It stopped the bleeding, but the global economy was left deeply wounded. The 2008 crash wasn't a single mistake. It was the slow buildup of blind faith in a system no one fully understood. And then, when the world finally started to recover, everything was shut down by something no market could control. The pandemic crash, 2020. This one didn't start with bad loans or greedy banks. It started with a cough and ended with markets in free fall. In early 2020, news of a virus in Wuhan barely made a ripple on Wall Street. Most investors shrugged it off as a regional health scare. But by February, infections were spreading globally. Lockdowns began, borders closed, and the reality hit. Entire industries were about to be shut down. Markets reacted with historic speed. Between February and March, the S&P 500 fell 34% in just 33 days. Airlines halted operations. Oil prices turned negative. Supply chains collapsed. And in 1 week alone, over 6 million Americans filed for unemployment. Governments responded with emergency stimulus. Central banks slashed rates. Trillions were pumped into global economies. The recovery was surprisingly fast, but the damage was deep. Businesses closed permanently. Inequality widened, and faith in global systems were tested like never before. The pandemic crash exposed how fragile the modern economy really is. No one saw it coming. No one had a playbook, and no one forgot how quickly everything can stop. But as markets tried to recover, a new kind of frenzy exploded. One fueled by memes, emojis, and a total rejection of traditional investing. Crypto and meme stock bubbles 2021. It looked like a revolution until the charts turned red and the dream collapsed in real time. After the pandemic crash, millions of people stuck at home turned to trading apps. With stimulus checks in hand and nothing to lose, they flooded into stocks and crypto. But this time, it wasn't about fundamentals. It was about community, rebellion, and going viral. GameStop led the charge. A dying retail chain turned into a battleground between small traders and hedge funds. Prices skyrocketed over 1,700%. Reddit celebrated, billion-dollar firms panicked, then came AMC, then Dogecoin, then NFTs. If it had hype, it had value. Bitcoin hit $60,000. Ethereum soared. A meme coin started as a joke reached a $90 billion market cap. Celebrities and influencers joined in. For a while, it felt like the rules no longer applied. But the crash came fast. Luna collapsed. FTX went under. Meme stocks tanked. Billions were wiped out, mostly from everyday investors who believed they were part of something unstoppable. These bubbles weren't built on balance sheets or business plans. They were built on momentum, memes, and mob psychology. It wasn't logic driving the surge. It was FOMO. And when the hype died, so did the money. And now that we've walked through every major collapse, the bigger question remains, why do we keep falling for the same traps? So after tulips, fake trade routes, meme coins, and million-dollar JPEGs, have we actually learned anything? Maybe not. Each generation believes it's smarter than the last, that it sees the warning signs others missed, that this time is different. But fear and greed, they don't retire, they evolve. They follow us into every new technology, every new market, every new promise of easy money, and that's why the cycle always returns. Which crash do you think taught the harshest lesson? And could that same mistake happen again today? If you want to understand the patterns that keep crashing our economy, subscribe and drop a comment with the crash you think we should cover next.